September 5th, 1929. A room full of businessmen in Boston shifts uncomfortably as Roger Babson steps to the podium. His voice is calm, but his words land like grenades. "A crash is coming," he says, "and it may be terrific." The audience laughs nervously. One banker whispers to another, "The old fool's been saying this for years." Newspapers the next morning mock him. The Wall Street establishment dismisses him as a perennial pessimist, a man who sees disaster in every shadow. 47 days later, that banker loses everything. The Dow Jones crashes 25% in 2 days. Fortunes built over generations vanish before lunch. Suicides make headlines. Men who were millionaires on Monday are penniless by Friday. Bread lines stretch for blocks. The Great Depression begins its decade-long devastation of the American economy. But here's what nobody tells you. Babson wasn't guessing. He wasn't lucky. He wasn't a mystic with a crystal ball. He had identified a 5-stage pattern that appears before every major market collapse, a sequence so consistent, so mathematical, that once you see it, you cannot unsee it. The same pattern preceded 1987. The same pattern preceded 2000. The same pattern preceded 2008. And right now, in January 2026, all 5 stages are active. We're not waiting for the pattern anymore. We're inside it. The trigger stage has begun. Let me show you the sequence, stage by stage, crash by crash. Because the people who lost everything in 1929 had no warning. You do, right now, in this video. Before we examine the pattern, you need to understand who Roger Babson was and why his prediction wasn't luck. Babson was a statistician and economist who founded Babson College. He spent decades analyzing market data, looking for recurring patterns in economic cycles. While Wall Street celebrated the endless bull market of the 1920s, Babson saw something different. He saw mathematics. He saw debt levels. He saw concentration of wealth. And he saw a sequence that had appeared before every major financial panic in American history. His framework identified 5 stages that precede market catastrophe. Not every correction, not every dip. Catastrophe, the kind that destroys wealth for a generation. Stage 1. Credit explosion. Easy money floods the system. Debt grows faster than the economy. Leverage multiplies. Everyone borrows because borrowing is cheap and assets only go up. Stage 2. Concentration trap. Wealth and market gains concentrate into fewer and fewer assets. A handful of stocks drive all the returns. A handful of institutions control most of the capital. The system becomes fragile because it depends on a narrow base. Stage 3. Smart money exodus. The insiders start selling. Quietly, at first. The people who built fortunes in the boom begin converting paper gains to cash. They don't announce it. They don't explain it. They just leave. Stage 4. Liquidity illusion. Everyone believes they can sell when they want to. The market feels liquid. Prices are stable. Experts declare a new era. Famous economists make famous predictions about permanent prosperity. This is the stage where denial is strongest. Stage 5. Trigger event. Something breaks. It's never the real cause. Well, the real cause is the debt, the concentration, the fragility. But the trigger is what people remember. A speech, a bankruptcy, a policy change. The match that lights the gasoline that was already soaked into everything. This is the Babson pattern, 5 stages, and it has repeated with terrifying consistency for nearly a century. Let me show you. The 1920s were the greatest bull market America had ever seen. The Dow Jones rose 500% from 1921 to 1929. Ordinary Americans became stock market investors for the first time. Cab drivers gave stock tips. Shoeshine boys discussed margin positions. Stage 1. Credit explosion. By 1929, margin debt had reached unprecedented levels. Investors could buy stocks with just 10% down. That means 90% leverage. You put up $1,000, you control $10,000 in stock. When stocks rise, you're a genius. When they fall, you're wiped out. The Federal Reserve kept interest rates low throughout the decade. Easy money fueled speculation. Total broker loans, money lent to buy stocks, reached $8.5 billion by September 1929. That's over $150 billion in today's money. The debt was staggering. Stage 2, concentration trap. By 1929, the top 1% of Americans owned 40% of all wealth. The stock market gains were concentrated in a handful of sectors: automobiles, radio, utilities. The broad economy wasn't nearly as strong as the market suggested. Farmers were struggling. Manufacturing was slowing, but the stocks kept climbing. Stage 3. Smart money exodus. This is the stage nobody talks about. In the summer of 1929, the smartest money in America started selling. Joseph Kennedy, father of the future president, famously said he knew it was time to get out when the shoeshine boys started giving him stock tips. He liquidated his positions and walked away wealthy. Bernard Baruch, one of the era's most successful speculators, quietly reduced his holdings throughout 1929. The insiders saw the pattern. They didn't announce it, they just left. Stage 4. Liquidity illusion. On September 3, 1929, 2 days before Babson's warning, the Dow hit its all-time high. Irving Fisher, the most famous economist in America, declared that stocks had reached a permanently high plateau. Permanently high. Plateau. Those 3 words would haunt Fisher for the rest of his life. He lost millions. His reputation never recovered. But in September 1929, everyone believed him. The denial was total. Stage 5. Trigger event. September 5, 1929. Roger Babson delivers his warning at the National Business Conference. Sooner or later, a crash is coming, and it may be terrific. The market drops 3% that day, what newspapers called the Babson break. But it recovers. People dismiss it. And then, 47 days later, everything collapses. October 24th, 1929. Black Thursday. The market falls 11% in a single day. Bankers meet and pool resources to stabilize prices. It works for a few days. Then October 29th. Black Tuesday. The Dow crashes another 12%. Over $14 billion in value disappears in one day. The crash would continue for years. By 1932, the Dow had lost 89% of its value. The pattern worked. 5 stages, complete collapse, and nobody listened to the warning. Let's jump forward 58 years. October 1987. The market had been roaring since 1982. The Reagan bull market, new financial engineering, portfolio insurance, a mathematical strategy that supposedly protected against losses by automatically selling as prices fell. Stage 1. Credit explosion. The 1980s saw the rise of leveraged buyouts and junk bonds. Corporate debt exploded. Financial innovation meant more leverage, more complexity, more interconnection. The system was loaded with debt, hidden in new instruments that regulators barely understood. Stage 2. Concentration trap. By 1987, a new phenomenon had emerged: program trading. Computers executing massive trades based on algorithms. By some estimates, program trading accounted for 25 to 30% of daily volume. The market's fate was increasingly determined by a handful of institutional players running similar strategies. Stage 3. Smart money exodus. In August and September 1987, institutional investors began repositioning. The bond market started flashing warnings. Long-term Treasury yields rose sharply. Some funds quietly reduced equity exposure. The insiders were hedging. Stage 4. Liquidity illusion. This time is different. The 4 most dangerous words in finance. In 1987, the belief was that portfolio insurance had eliminated downside risk. Mathematical models proved you couldn't lose. The computers would protect you. Stage 5. Trigger event. October 19th, 1987. Black Monday. The Dow Jones falls 22.6% in a single day. That's still the largest single-day percentage drop in history. $500 billion in value evaporates. What happened? The portfolio insurance that was supposed to protect everyone did the opposite. As prices fell, the algorithms automatically sold. As they sold, prices fell further. As prices fell further, more algorithms triggered. It was a cascade, a death spiral of automated selling. The trigger was a combination of trade deficit news, rising interest rates, and geopolitical tensions. But the cause was the pattern: debt, concentration, insider selling, false confidence, and then the match. 5 stages, same sequence, different decade. Let's jump forward. 13 years. March 2000. The Internet had created a new gold rush. Companies with no revenue, no profits, and no viable business model were valued at billions. Pets.com, Webvan, eToys. The theory was simple. The Internet changes everything, profits don't matter, and if you're not invested, you'll be left behind. Stage 1. Credit explosion. The late 1990s saw an IPO frenzy unlike anything since 1929. In 1999 alone, 457 companies went public, raising $69 billion. Day trading became a national hobby. People quit their jobs to trade stocks full-time. Margin debt reached all-time highs. Stage 2. Concentration trap. By early 2000, the market's gains were driven almost entirely by technology stocks. The Nasdaq was up 400% from 1995. But within the Nasdaq, a handful of names drove the returns: Microsoft, Cisco, Intel, Oracle, Sun Microsystems. If you didn't own tech, you were losing. Everyone crowded into the same trade. Stage 3. Smart money exodus. In December 1999 and January 2000, insider selling reached historic levels. Corporate executives were dumping stock as fast as they could. Jeff Bezos sold $500 million worth of Amazon shares. Bill Gates reduced his Microsoft holdings. The founders and early investors were taking money off the table. Stage 4. Liquidity illusion. The new economy. Profits didn't matter because growth mattered. Eyeballs mattered. Market share mattered. Traditional valuation metrics were obsolete. The old rules didn't apply. James Glassman and Kevin Hassett published Dow 36,000 in 1999, arguing that stocks were dramatically undervalued and the Dow would triple within years. The denial wasn't just widespread. It was celebrated, published, and broadcast. Stage 5. Trigger event. The Nasdaq peaked on March 10, 2000 at 5,048. There was no single trigger. Just the gradual realization that companies valued at billions had no path to profitability. The selling started, and once it started, it didn't stop. By October 2002, the Nasdaq had fallen 78%. $5 trillion in market value had disappeared. Pets.com became a punchline. The sock puppet became a symbol of excess. 5 stages. Same pattern. Different technology. Let's jump forward 8 years. September 2008. The housing market had become the engine of the American economy. Home prices only went up. You could buy a house with no money down, no income verification, and flip it for profit within months. What could go wrong? Stage 1. Credit explosion. Subprime mortgages. Adjustable rate loans. No doc loans. The mortgage industry had abandoned underwriting standards entirely. And the debt didn't stay with the lenders. It was packaged into mortgage-backed securities and collateralized debt obligations sold to investors worldwide. By 2007, there was $1.3 trillion in subprime mortgages outstanding. Stage 2. Concentration trap. By 2008, the 5 largest banks controlled 70% of total banking assets: Bear Stearns, Lehman Brothers, Merrill Lynch, Goldman Sachs, Morgan Stanley. The fate of the global financial system rested on a handful of interconnected institutions. They all owned the same toxic assets. They all had exposure to each other. Stage 3. Smart money exodus. John Paulson became a billionaire by betting against subprime mortgages. He saw the pattern in 2006 and started building his position. By 2007, other hedge funds were joining. Goldman Sachs was simultaneously selling mortgage products to clients and betting against those same products for its own account. The smart money knew, they just didn't tell anyone. Stage 4. Liquidity illusion. The subprime problem is contained. Ben Bernanke, chairman of the Federal Reserve, said those words in March 2007. Contained. The housing market was crumbling, foreclosures were spiking, and the Fed chairman said it was contained. Hank Paulson, Treasury Secretary, said the housing correction was at or near the bottom in April 2007. The experts were unanimous. The system was fine. Stage 5. Trigger event. September 15, 2008. Lehman Brothers files for bankruptcy. $600 billion in assets. The largest bankruptcy in American history. And suddenly, the entire financial system freezes. Credit markets seize. Banks stop lending to each other. The global economy comes within days of total collapse. The government bails out AIG, Fannie Mae, Freddie Mac. The Dow falls 54% from peak to trough. 8 million Americans lose their jobs. Trillions in household wealth evaporate. 5 stages. Same pattern. Different instrument. Same result. Now let's talk about right now. January 2026. Let me walk you through the checklist. Stage 1. Credit explosion. Corporate debt in America has reached $13 trillion. That's double what it was before 2008. Consumer debt has surpassed $17 trillion. Credit card debt alone is over $1.1 trillion, with average interest rates exceeding 22%. Student loans, auto loans, mortgages. Every category is at or near all-time highs. The government debt is $36 trillion and climbing by $1 trillion every 100 days. Interest payments on the national debt now exceed $1 trillion per year, more than the defense budget. Margin debt, money borrowed to buy stocks, hovers near all-time highs. The leverage is everywhere. Stage 1, check. Stage 2, concentration trap. The Magnificent Seven. Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, Tesla now represent over 30% of the entire S&P 500. The top 10 stocks account for 35% of total market capitalization. This is the most concentrated market in modern history, more concentrated than 2000, more concentrated than 1929. And it's not just stocks. The top 3 asset managers, BlackRock, Vanguard, and State Street, control over $20 trillion. The system is fragile because everything depends on a handful of names. If the Magnificent Seven falter, the entire market falters. There's nowhere to hide. Stage 2. Check. Stage 3. Smart money exodus. Warren Buffett's Berkshire Hathaway is sitting on $325 billion in cash. That's the largest cash position in the company's history. Buffett isn't finding value. Buffett is waiting. Corporate insider selling reached levels in late 2024 and early 2025 not seen since 2021, right before the market peaked. Executives at major tech companies have been reducing positions consistently. Institutional investors have been rotating into bonds, gold, and cash. The flows are quiet, but they're measurable. The smart money is repositioning. Stage 3. Check. Stage 4. Liquidity illusion. Soft landing achieved. You've heard this phrase constantly. The Federal Reserve managed to raise rates and cool inflation without crashing the economy. It's over. We won. AI will transform productivity and justify any valuation. The new economy narrative is back. This time it's artificial intelligence. Nvidia trades at astronomical multiples because AI changes everything. Sound familiar? The consumer is strong. The labor market is resilient. The experts are confident. The denial is complete. Just like Irving Fisher's permanently high plateau. Just like the subprime problem is contained. Just like this time is different. Stage 4. Check. Stage 5. Trigger event. This is where we are now. The pattern is complete. We're in the trigger window. What will it be? I don't know. Nobody knows. The trigger is never the cause. The trigger is just the match. Maybe it's commercial real estate. Office vacancy rates are still elevated. Regional banks have massive exposure. The losses haven't been recognized yet. Maybe it's geopolitical. Multiple conflicts are active. Supply chain disruptions. Energy shocks. Any escalation could cascade. Maybe it's the debt ceiling. Another political standoff. A downgrade. A loss of confidence in Treasury securities. Maybe it's something nobody is watching. That's usually how it works. The trigger comes from the blind spot. But here's what the pattern tells us. When stages 1 through 4 are complete, stage 5 follows. It always has. 1929, 1987, 2000, 2008. The sequence is mathematical. Stage 5, active. 4 times in the last century, the same 5-stage pattern preceded catastrophic market collapse. Credit explosion, concentration trap, smart money exodus, liquidity illusion. Trigger event. Roger Babson saw it in 1929. Wall Street laughed at him. 47 days later, they lost everything. The pattern appeared before Black Monday, 1987. The pattern appeared before the dot-com crash. The pattern appeared before Lehman Brothers collapsed. And the pattern is complete right now, in January 2026. I'm not telling you to panic. Panic doesn't help. I'm telling you to see. The people who lost everything in 1929 weren't stupid. They weren't reckless. They were normal people who trusted experts, who believed the system was stable, who thought someone would warn them if danger was coming. Nobody warned them, and nobody is warning you. Except the pattern. The pattern is warning you. It's been warning for nearly a century, 5 stages every time, same sequence. The question isn't whether you believe me. The question is whether you see the pattern. If this opened your eyes to where we actually are in the sequence, subscribe. Because when stage 5 resolves, and it always resolves, you'll want to understand what happened and why. The answers aren't hiding in the future. They're written in the past. And I'll show you where to look.